USA wants war with Russia. Buy this portfolio now. This has been our headline for the last week or two. And it's not the US citizens, it's the US military complex. What we're going to cover today is a $10,000 trade alert if you're just getting started with Portfolio Builder. And our three assets are all up today, which is exciting. Step one, pick up 89 shares of UVXY. This is our stock crash insurance. It's not betting that various equities just go down. It's actually a bet that they'll accelerate down. And so what's important is that we can be long our growth and value assets and have asymmetrical returns if there's a crash that takes place. People are asking about inverse ETFs. That does not do that. You just break even. If you go long and short, you just break even. That's complete nonsense. So yeah, you want to have a product that can actually make more on the downside than your long position. So it's a insurance policy. And last time we had a big black swan event in March of 2020, this went up 1,100%. So if you had a 10% position and 90% of your portfolio went to zero, without touching anything, you're up 10% at the peak panic. Okay, and that's the kind of downside protection our clients have at all times. Now, we're actually expecting that the bond market crash has been overdone. Global growth is slowing down. I believe we're on the verge of rates stabilizing and falling, and this is going to skyrocket our favorite asset, Ethereum. So step two is to pick up the best growth asset of the decade, and we can have exposure to this with the Grayscale Trust, ticker ETHE. Buy 223 shares. Here's a look at that chart. And I do believe we're not just going to break into new highs, we're going to explode beyond the recent high. I actually can see Ethereum trading well over $10,000 a share. And again, that would put the ETHE Trust probably around 75 bucks. I'd have to do the math, but huge, massive upside ahead to buy and hold our favorite growth asset. Now, there's a problem in the economy, as we all know, and it's the sticky inflation that just won't go away. And very interesting. We've got China starting to print money faster, I believe, than they ever have in history, as the US Fed is starting to hike rates. The last two times this exact situation happened, the best returning asset was natural gas. We're long this with oil. This is your inflation hedge or your interest rate hedge. Okay, so you have growth, value, and insurance in case things go really bad. And here's a look at oil. It's actually jumping up today due to fears of Russia invading Ukraine. And again, we got Russia and Ukraine say they're not going to do this. And we've got the US State Department saying it's an imminent attack. And really, we just got to watch this play out. So it's going to be very, very interesting here. It does look like the US wants some sort of conflict here and are trying to force this to happen. So if that does occur and there is a conflict, most likely Russia will restrict natural gas and oil into Europe, and oil could go parabolic. Just last September, we saw oil hit over 90 bucks, and the US had to rescue Europe by shipping lots of our natural gas out there. And that was without Russia being forced into a corner here. So this is a very, very important hedge with the geopolitical problems that are developing as we look at this. Let's look at the asset allocation breakdown of your $10,000. Right now, 15% in the crash insurance. And again, this goes up faster than stocks go down. This does not have anything to do with an inverse ETF. It's far different in the way it responds to market behavior. So UVXY at 15% is huge. As soon as this conflict resolves and we start to see the bond market cool off, I do want to get that back down into the 7 to 8% range. Right now, we've been letting it ride and it keeps going up in value. So again, we get a big crash, we have nothing to worry about because we're over 10% in the crash insurance. Now, most likely, I believe this conflict could settle down here, and it's just going to be a lot of cat fighting. If this occurs, then energy costs are going to fall and interest rates should fall. And that's going to most likely make Ethereum go parabolic to the upside. So this is one of my favorite positions. Really beautiful setup for yields to fall. It's already trading at 50% discount from recent high. Beautiful setup for our growth asset. Now, if we're wrong on the inflation front, we've got PPI coming out tomorrow. The bond market keeps collapsing. The best correlated trade is to be long energy. Now, oil is flirting with $95 a barrel, but natural gas is down significantly from its recent high. So we like oil right now as a better inflation or interest rate hedge to protect your growth asset. So you put this together, it's a beautiful portfolio. We've got UVXY up slightly. We've got Boyle up 8%. So 3 out of 3 up. Meanwhile, just about everything else out there is down on the day. This high risk growth portfolio returned 233% in 2021, turning every $10,000 into $33,000. Are you ready to triple your money this year? Here's the big picture. Global economy is slowing down. The US is starting to tighten up monetary policy, and they're not going to pass any more fiscal stimulus until the CPI really falls quite quickly. I'm expecting it to peak in March and fall into April, but we'll have to see just how fast it falls for more stimulus. Now, again, a lot of people think we need the Build Back Better bill to pass for Ethereum to go up. That's actually the opposite of what I've been telling you. We want rates to fall for Ethereum to go up. And so more stimulus would most likely crack the bond market right in half. So I'd be more bullish on energy, not Ethereum, once that Build Back Better bill passes. So this is the perfect setup for how we're positioned with these exact ratios. Now, the CPI last Thursday was hotter than most expected, but from how I'm evaluating it, we did have a slight decrease in the rate of change of inflation, which is what I was hoping for and exactly what occurred. So I think we're going to see this slow down into March and fall into April. And that's exactly how we're positioned. Key macro events ahead. The NATO, well, we did have Ukraine say they want to join NATO. Russia says if that happens, we've got war on deck. So very interesting developments here. Very hard to make heads or tail out of what's going to exactly come out of this conflict. But the more it aggravates, most likely the higher natural gas is going to go up. And again, if China is getting ready to expand credit and the US is going to go into a rate hike cycle, the last 2 periods this happened, the single greatest returning asset was natural gas. So throw a little fire on that with Russia, Ukraine, NATO, and that could sure turn out to be a big winner for our portfolios. And so when we look at the big picture, what are your alternatives? Cash is trash. We're spending more money than we make at every major government. And bonds are still ugly, but I gotta admit, bonds are getting closer to a buy signal from me. I love being long bonds. When we have $300 trillion in debt globally, when you do the math, these interest rates cannot go up a whole lot higher. So as far as being able to have smooth returns with low volatility, bonds are your best friends once they get priced correctly. So we're at some pretty critical levels. We got PPI coming in tomorrow. We'll take a look at when we might pull the trigger on a bond position at the very end of this video. And again, that will only be for paid members. So that's an exciting trade that's getting closer and closer to pulling the trigger. So when we look at the 30-year Treasury, it needs to hit a range of 2.5% to 3%. for me to pull the trigger on a massive position into this. And so some people are actually predicting the 10-year could hit 3%. And I don't think that's possible without imploding global markets. In general, what I'm expecting is the 30-year will creep up to 2.5 for us to pull the buy signal, and the CPI is going to fall right in line to that CPI within the next 24 months. So I think within 24 months or less, and a lot of times these things happen much faster, is we're going to see the CPI fall towards that 30-year interest rate. And we're going to want to pull the trigger before they overlap, because we'll already have peak yields in. So exciting moves in the bond market continued to develop here. But I do want to see the conflict with Russia resolved, because that could make energy costs go up and further destroy the bond market. So we're going to hold off a little bit. So right now, investors really have no other logical option. We see all this crazy volatility this year, up and down in stocks. It's because people have nowhere else to put the capital. And that's why I do expect stocks, cryptocurrencies, and commodities to continue melting up until bonds become attractive, or until the government balances its budget. We actually had our first surplus in many decades, I believe. Not many decades, many years, where the government spent less than it brought in, but that will be a one-off. So it's critical you watch our webinar every Monday, Wednesday, Friday to be ready for sell and buy alerts. When you're on your trial or catching this on YouTube, you'll get the entry point, but unless you upgrade, you're going to miss out on the changes to the portfolio. So call Dean. There's 3 spots per day at a special deal at 505-322-7515. Okay, we'll review the portfolios towards the end of the webinar and the safe growth strategy. I want to jump into the headlines hitting today, which have been bizarre to say the least. And I'll take a quick look at questions really quick before we jump into all of this. We got people asking about UVXY. Yeah, so it's UVXY is going to lose 2% a week, and it's a futures product, so it's not like a stock. You shouldn't be looking at charts like that to understand its here. We'll look at the futures curve to understand whether or not the VIX is in a good spot to make money. And just real quick, just spoiler alert, it's in the perfect position to make a ton of money right now. So if the futures curve is flat or slanted down, any more volatility will send UVXY skyrocketing higher. If it were slanted up, we would have some work ahead. Okay, it looks like that's the most important questions. Okay, so we got China. Let's see. JP Morgan says the market is pricing in a high probability of a 50 basis point move in March and a total of 175 basis point over the next year. Can markets get any more hawkish? Probably not. And that's what I expect too, that we're going to have more of a dovish surprise due to the money supply and fiscal stimulus slowing down the economy. RBC sees an oil super cycle, prices to touch 115 a barrel or higher this summer. It says tightening product and crude inventories are difficult to solve absent a demand destruction event or a supply surge, neither of which appears to be on the horizon. I do expect to see oil eventually hurting markets. But I do think we're going to have a pullback first and a new opportunity to re-enter as the global economy is slowing down. Okay, the Ukraine president put out a joke that they were given notice that they would be invaded Wednesday. The market sold off on that news, and I found it bizarre that they would know exactly when some sort of a attack was going to begin. So we're getting these crazy headlines. Meanwhile, 100 plus Russian battalions are on the border and tanks are moving in. So make no mistake, this is still escalating. Pentagon spokesman says still does not believe Putin has made a final decision to invade Ukraine. Satellite images show Russian troops leaving assembly points and moving to attack positions. US is closing embassy, relocating diplomatic operations, according to Wall Street Journal. Ukraine seeks peace and wants to deal with all issues only through negotiations, Zelensky says. Chinese state-affiliated media mocking the US, Biden and Blinken, have you decided when Russia should, quote, invade Ukraine? Looking at the rate of change of some of the portions of the CPI that were hurting everything are flatlining. So we're seeing rent, medical care, food, college, gas, gold, all of this is cooling off. So I really think that the bond crash is really coming to an end. And this will be very good for how we're positioned. Goldman Sachs published an 89-page slideshow with 245 charts of why investors should buy Chinese stocks. Boils down to this: China is easing. Now, if you're in our safe growth strategy, where we recommend you place 70% of your capital, that's our biggest equity position in emerging markets, which has been selling off for the last year. So if there's downside in equities, we expect there to be far less in emerging markets. And if there's going to be upside from here, far greater returns out of emerging markets compared to the US. Okay, where we are in the super cycle, energy stocks are now dropping on higher commodity prices, which are now viewed as recession triggers. So we actually got the NRGU down today, 8%, while oil is up 8.4. Just some clips coming out of Russia, tanks moving in. UK foreign minister says Russia could invade at any moment. And then this was probably the most conflicting message today that could create wars. Zelensky reiterates Ukraine seeks to join NATO. Russia has said they will start a war if that occurs. Chai Girl says not only is China's credit impulse starting to rise off the floor, it looks like they're going to go on a stimmy binge again. China's infrastructure projects will likely boost these companies. China is relying on government spending as a source of growth. In layman's terms, this is incredibly bullish commodities. Pelosi, an assault on Ukraine is an assault on democracy. Lynn Alden points out during the past 4 decades of disinflationary trends, the 10-year Treasury yield never went over the prior cycle's top in the federal funds rate, defined here as at least 150 basis point cut rather than minor mid-cycle tweaks. To do so this time would suggest a macro regime change. So she's saying, and if you look at this, not only did the 10-year never go above the previous federal funds rate, it never even comes close. Okay, every single cycle. And this phenomenon is due to the growth of debt, which is now over $300 trillion. So I think we're very quickly approaching a buy signal for bonds. And again, that makes our job so much easier over here because everybody wants to know what asset can protect your equity positions or commodity positions in a slow sell-off. And the answer is not UVXY. The answer is the bond market, but not until those bonds hit a fair value relative to the inflation. So this would put the peak 10-year at 2.5, and today now it's trading at 1.996. So assuming this could touch the top, that would be 25% higher from where we're currently at. But I don't see anything to tell us that it's going to happen right now. I think we're going to see rates come back down, potentially pass a lot more stimulus with recession fears, and then drive to those higher rates. So we'll see. So far, the bond market crash continues to surprise everyone, and as does how sticky the inflation has been so far. But really interesting chart here. Joe Manchin says the Federal Reserve needs to stop pussyfooting around and tackle inflation head on. And that's what's stopping all the fiscal stimulus for now. Alf says, zooming in, the last 700 years history of interest rates reveals that nominal rates indeed hovered around 3 to 4%, but real rates dropped by 1% per century. A credit-based monetary system with poor demographics needs more and cheaper debt to survive. And so you can see this long-term trend of rates going lower and lower as debt grows greater and greater. And not only do we have the lack of young people to support the old, we also have technology replacing high-paying jobs. So this problem gets worse and worse over time. Now this is a reporter, I think for Time Magazine. I admit, but that follows Russia and Ukraine. I admit I have not seen the intelligence, but there's never been a time when my understanding of Russia, my 15 years of reporting on Russia and Ukraine, has been so at odds with what the US government says about Russia and Ukraine. So yeah, very, very bizarre action happening here. Okay, so I think that's my key headlines I wanted to cover. Okay, now here's an interesting chart. Commodity returns during the Fed rate hike cycle, and it's looking at 2015 to 2018 and 2004 to 2006. And the highest daily return was US natural gas, which we are currently long. Now, Daniel D. Martino Booth says 2 episodes during which China chose to be a marginal global buyer to the world economy's benefit. Well, guess what? They are also now stepping up the spending. And this is the trend. Whenever the US tightens, China tends to do the opposite. And these central banks take turns doing this to keep the party rolling along. Okay, I think we'll move into okay, so now we're going to go ahead and look at some charts and data. That 2-year keeps going straight up. This is what tends to lead the federal funds rate. And so I'm wondering if hiking rates may actually appease markets at this point and stop this bond crash. So they had the chance to end QE early and decided not to. So they're still printing away and no expectation to stop. They published a schedule. So QE ends mid-March, and that's when we're going to expect probably only 25 basis point hike. I don't think they're going to even pull the 50 basis point right away. But you can see the short end is going up much faster than the long end. And this is bad news. Here is the probability of a 50 basis point rate hike, now over 50%. So far the Fed's been way behind the curve and continues to drag its feet on anything hawkish. They talk a big game, but then keep printing money. So we'll have to follow this all the way to March. But most likely, they're going to continue to be a little bit behind the curve is my expectation, as the inflation should dramatically slow down between March and April. The reverse repo still stubbornly stuck at $1.6 trillion. This is a quantitative easing buffering, protecting the bond market. So again, no expectation that the bond crash should go beyond these current levels right now. And we're getting very tempted to start adding to our adding to a bond position. All right, here is Boyle against NRGU. And so it's been going up faster than NRGU over the last 24 hours. Now that's after NRGU had a really nice run up that we did not take place in. We'll zoom out to this point. So if we go back to the 25th of January, we saw natural gas spike, crash, and it's starting to build back. And we've had NRGU just steadily climbing. So right now, we're using Boyle as our inflation hedge. And these two tend to be very correlated over time. So if we look at this from a further zoomed out point, a lot more potential upside for Boyle to catch up to peak prices, especially if this conflict escalates, because I think oil can only go up a few more dollars, most likely, before things start to crack. This is comparing oil to lumber futures. Lumber futures has actually been good at predicting oil prices. If we go back to May, lumber futures crashed, and 2 months later, oil had a pretty significant sell-off. Then lumber futures rebounded, oil rebounded. At this point, we have oil and lumber futures rising quite rapidly, plus copper futures. So I think natural gas is on the verge of catching up to all of these plays. Here's the copper futures. And China is most likely going to drive this higher if they're getting ready to go on a spending binge. We can see it's in a clear uptrend. Baltic Dry Index has stopped crashing and starting to rise once again. So the inflation play is still intact. Here's a look at the NASDAQ, interest rates, and NRGU. And we can see when the yellow line goes down, we're getting a bid on tech and a crash in value, or oil and gas. When rates are rising, we're getting that run up in NRGU and the sell off in the NASDAQ. Now, in this most recent move, we got rates going up and NRGU falling. So that oil's starting to get to too high of a price that it may start to kill demand. Now, a trade that I want to get us into to have exposure to oil at a discount is actually the Russian stock market. But we got to see this conflict resolve, and then I believe we'll see a big catch-up play. I'm actually expecting soon as the conflict resolves that we will see oil sell off to the $80 to $85 range. And then at that point, we would want to go back long with either NRGU or RSX, or perhaps both. Most likely RSX will be a high risk play, and we'll stick to the big US oil and gas companies for safe growth. Right now, we're using natural gas to hedge against further energy inflation risk. Here's emerging markets related to interest rates, and we can see in general, we've seen interest rates falling with emerging markets falling. And so right now, our expectation is at least for the bond market to stabilize. And so if that's the case, I do think Ethereum is going to be our big winner right now. We might be a little early on emerging markets taking off to the moon. We might need that more aggressive stimulus to come in. So at this point, haven't changed any positions in the safe growth strategy. I do like that it's trading at a deep discount relative to its recent highs, and that China is going into a credit expansion cycle. So if I were to move money out of equities in the safe growth strategy, most likely it would be from UPRO and EFA into TMF, into treasuries. Not ready to make that call right now, but that's where I see the greatest equity risk in the short term. Russell 2000, starting to follow those rates quite closely again. And this is probably our most bearish US index. Fell out of its range, which it has been holding on to quite impressively with rates falling. It was able to stay sideways. And now it's broken out of that channel. So keeping a close eye on the Russell 2000. We're not in that play, but that is used to predict market action. EFO, definitely at risk of war with Russia and in Europe, plus rates falling. So we did well with EFO. It's been trading flat, and I don't see anything to make rates rise from here. So this is a position I'm considering rotating into bonds for a safe growth strategy. Here's the dollar index. As far as a major repositioning in the portfolio, I'd like to see the DXY hit 90. And so that could take quite some time to play off. So we're probably going to be relatively stubborn with our positioning for quite some time. No action on the Chinese currency, still trading very strong. We're looking at that in case some sort of contagion from their real estate bond market causing a devaluation of their currency. Here's a look at some of the pain in the tech sector. We've got Apple down 3%. This is from the February 10th. We've got NVIDIA down 7.8. They have earnings this week. Tesla down 5, Microsoft down 4, Amazon down 3, Google down 3, Apple down 3. Let's see, we got a question. High risk is, there's no trades coming anytime soon. Really for any of these portfolios, they're really set to jet until we get a better idea of what's happening with inflation and with the Russian conflict. Now in this chart, we're looking at interest rates in yellow, and then we're looking at Berkshire Hathaway, JP Morgan, and Bank of America. And we're just trying to observe if we're getting a growth to value rotation. And so if I zoom out, Berkshire Hathaway has been doing really well here since the 6th of December. Berkshire Hathaway has gone up 12%, outperforming the banks, two of the bigger banks. So Warren had underperformed markets during the QE period, but now that things are coming back to normal, he's doing very well. Now in this chart, we're looking at Alibaba, Tencent, and Taiwan Semiconductors. And we'd like to see Alibaba and Tencent start to outperform Taiwan Semiconductors due to being sold off 55% from its peak for Alibaba and 35% for Tencent, while Taiwan Semiconductors remains near all-time highs. And so starting to see that, you can see Alibaba is slowly but surely starting to outperform. And from the 6th of January, Alibaba's up 9%, Tencent's up 5%, while Taiwan Semiconductors is flat. If I zoom out a bit more, we can see that big discount. And again, in safe growth, that's where we are betting big, essentially in Alibaba and Tencent. Toyota Motors down a little bit, but still just kicking ass, taking names, up 42% since October of last year, of 2020. And this is what we're using to gauge risk in the EFA ETF. Now we're watching Exxon to predict any problems in the oil markets. And so interesting, we got oil up hitting the 95 level and Exxon selling off from its peak. So very, very interesting to see that starting to play out. This is where we're looking at the 10-year against the 2-year spread. And anytime this goes negative, usually what happens is the yield curve inverts. That's what happens when it goes negative. And then then we get the steepening. The long end goes up until it crashes markets. So this typically is 16 months out from a crash, and it's when the long end rises that we get problems. So it's headed that way, and we'll see if some rate hikes can change that, or if the inflation starts to slow down. But in general, if we're going to want to see no yield curve inversion, that 2-year needs to come down very soon, and it just keeps going up, up, up. But this has predicted each stock crash for several decades. Now, here we're looking at the TLT. And so from a technical perspective, I'm wondering if we're going to bottom out here, basically right now, or if we're going to break through this support line and find support probably around 124. I would be very aggressive buyer of the TLT. We'd use TMF if we break below this channel. I don't see any catalyst to get us there. So unless the inflation and PPI keep going up and do not slow down, I find it highly unlikely right now that in the short term this goes any lower. So if yields are about to stabilize and fall, which means TLT goes up, most likely your best performing assets will be Ethereum and the NASDAQ. And I like Ethereum far more than the NASDAQ, as it's down 55% from its recent high. Here's our Tesla Ethereum comparison. Only asset that's outperformed Ethereum over various parts of time is Tesla. And so I do like to track both of these. And again, if yields are oversold and about to stabilize and rise, I'd expect both of these to go up significantly from here. So we're keeping a close eye on it, but just remarkable how correlated these two are. And depending on what time range you're looking at, you can see one or the other outperform, but both very, very correlated. Now, gold and silver is getting a bid. And the last two big cycles for them were doing rate hikes. So carefully monitoring this to see if we want to get some gold and silver back into the portfolios or not. But what a run up for these assets that have been so boring for a good year. Now, if I zoom out a bit, we can see just how boring they have been. So there's gold and silver doing a whole lot of nothing for quite some time. I would rather go long silver for more leverage with the same idea if we were to add to that. At this point, we have not made that call. Here's a look at the positions for a deflationary environment. EUO to go long the dollar against the euro. Then we got TMF treasuries. That's a leveraged dollar play in general. And then UVXY. At this point, we're only long UVXY. Now in safe growth, where we put more money, we're currently long uranium and REMX, rare earth metals. And I do like those both long-term. We need uranium to create nuclear power plants to have a chance at this low CO2 emission world. That seems to be a global agenda. And the growth of tech is specifically going to put huge demand into rare earth metals. There's really nothing that I see dramatically changing that. So those remain our two alternative energy plays. So lithium for the batteries, for phones and electric vehicles, and then obviously uranium for nuclear power. Currently not long copper miners or tan, but both similar plays. Now those ones don't tend to protect you against interest rates rising. We need the more predominant energy products. So oil or natural gas are the two ways we hedge against that. And looks like we got a really nice setup coming in for oil. Gold copper ratio has been relatively flat, but still generally going up, predicting higher interest rates. Here's a look at the yield curve. Steven says, why does Jason like silver more than, yeah, just you could make more money on silver. So we could put a lot less money into it and not hog up a lot of our assets in a non-income earning asset. All right, now in this chart, we're looking at the yield curve, and the blue line is today, and the black line is before Trump and Biden overdid the economy with too much stimulus. And so they have screwed up our bond market, and these Federal Reserve people just cannot figure out how to fix this thing. So the shape in the black is what they want, and the shape in the blue is what they don't want, and that's where we're at today. So the 2-year just keeps going up, and the long end is slowly rising. So this is headed towards a yield curve inversion, and then again, that's about 16 months out from a recession stock crash. So will hiking rates cool off the inflation expectations in the front end and bring back long-term growth expectations on the long end? That's what they are trying to maneuver. We'll see if they can pull it off. This is the VIX futures term structure. Again, the front months are above the forward months. So any more volatility in stocks and UVXY is really going to perform. Looks like Janet's done raising money. I think she's got about 700 billion in the coffer, which she raised very quickly. So again, I do think bond crash is coming to an end, and we should expect the yields to fall. The conflict with Russia being resolved should drive energy costs down and really push these yields down. So very bullish on Ethereum right now. This is the core inflation. What I was hoping for the way we're positioned was for this to come in below 6.1, and it came in at 6. So the jump went from 4.9 to 5.5.6, and then in the most recent print, up 0.5. So if we get prints in February and March that are less than 0.5, I believe that will be very happy for the bond market, and thus the Ethereum position and NASDAQ position. Anything above that, and I think the bond market's gonna be very upset. So very important data coming out. Now the PPI will get tomorrow morning, and so we'll see how this, I don't have a good gauge of what that will be, but hopefully this will start to also top out here. Here's the labor market. This data was completely revised, very bizarre. Let's not overthink the labor market till we get the February, March, April prints, which should be pretty good. Okay, but here's the sticky parts coming in. Will be rent, wages, and energy right now. But the rate of change of energy is slowing down. So really it's the wage pressure and the rent pressure right now, presumably that could keep the inflation hot moving forward. Labor force participation rates rising. Okay, so very inflationary. Bank credit continuing to grow. important if we want to remain long the way we're positioned. Consumer credit continuing to grow. We did have a slowdown in retail sales, but it's from record highs. So at this point, not worried about that. Balance of trade continues to grow negatively. Our debt continues to grow, which means we can be relatively bearish on the dollar, and that's how we're positioned currently. China's PMI had been flirting with negative territory, and it looks like they are aggressively expanding credit right now, which tends to happen when the US tightens. They tend to have some sort of deal to pass the printing. Chinese imports at $2.4 trillion and their exports at $3.4 trillion. So record level of import export for China. The US decided not to end QE early. So all this talk about how many rate hikes, and they're still, they could have ended the QE, but they're not. And the ECB continues to be very dovish. Lagarde says they will not start rate hikes until the bond purchases stop. But will the bond purchases ever stop? Okay, very good. Okay, so we're going to go through positioning and potential trade alerts in detail for paid members only. If you're on a trial, this is where you get cut off. There's 3 spots. If you call Dean at 505-322-7515, you gain access to the membership area where you can type in how much money you want to invest, and it will automatically calculate your trade alert. So don't delay, upgrade now.